When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Hogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Hogan. And now here's Jeff Hogan and Jeff Shade.
Thank you so much. Welcome to Premier Retirement with Jeff Hogan, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about current events, then the rule of 240 paychecks. The psychological concept of that. We'll also answer listener questions, and then we'll wrap up our discussion on thinking of your retirement as 240 paychecks instead of 20 years. My name's Jeff Shade, and I'm just here to ask the questions. But of course, the words of wisdom and solid advice, they come from the other Jeff in this radio program. It's Jeff Hogan, founder and president of Premier Retirement Planning and Wealth Management. Hey, Jeff, how you doing today?
Doing great. It's always fun to be with you and the listeners on this weekend.
And it is equally as fun for me to be here with you and all of our listeners. Of course, we're here for you every week for your fiscal fitness and your financial education on 790 KNST. Jeff, let's start off a little bit with current events. The Fed has signaled that more rate cuts could be on the way. What does that tell you about where we are in the economic policy?
I've mentioned this before on several radio shows. I know everybody doesn't listen to all of them every weekend, but every cycle in the market is repeated several times in the past and will repeat several times in the future. I mean, just get used to the idea that when you retire, it's going to be a 20 or 30 year, maybe even a 40-year portion of your life, maybe almost half of your or more of your adult life could be in retirement. There's a lot of things that are going to happen. There's a lot of economic cycles and market cycles. Typically, every decade, there's going to be a pretty good market correction or crash on average. In 2000 to 2010, we had two. Between 2010 now, we've had a few start, but never really come to finish. We had the 2018 bank crisis just right at the end of the year there that saw the market go down about 25%. It bounced back pretty quick. A couple years later, we had COVID, bounced down 30%, and then bounced back fairly quickly. 2022 was a bad year when the inflation started rearing its ugly head from all the money printing, and the market tanked about 25% on most of the indexes. And that looked like it was going to be another economic cycle that should have been a full economic cycle where we had the full drawdown, probably to about a 50% level to get the market back to what we call fair value. The problem with that is since the Obama years, just about 15, 20 years ago, we had, not quite 20 years ago now, but we've been finding out that we could do quantitative easing, or in other words, print money and get ourselves out of jams. And so these last few corrections that have been 20-ish%, which put us into what is technically called a bear market, but they've not lasted because they've just kind of thrown money at it and printed money. All that's done, though, is exacerbate the problem so that the last time inflation, once there was a little supply chain hiccup after COVID, we had the inflation monster rear its ugly head, and they had to raise rates in order to combat that and kind of slow money spending down. The problem is there's so much printed money and there's so many rich people that can buy whatever they want. Inflation only hurts the poor people in the middle class. It doesn't hurt the people that have money. And too many people were benefactors of all this money printing. Unfortunately, it wasn't the poor or the middle class. The majority of the country, it was the minority, and they're still able to prop up prices. They're able to prop up the stock market and do things that we haven't really seen. But if you look at history, to answer your question about the market cycles, typically what happens is there's decreasing economic indicators. We've had that for about 10 years straight. But if you look at the last 30 months or so, we've had every quarter, the economic indicator, leading economic indicator signal has been down except for maybe one or two of those months. That's a bad sign. Usually if it goes down more than about 24 months, we know we're going into a recession. We have the yield curve inversion, where the long-term interest rates are lower than the short-term interest rates, which we had for a couple of years, maybe more than that. It's actually about 30 months until it uninverted just recently. And the yield curve inversion means things are out of whack. And usually to get them back into whack there's usually a sell-off, a market correction, or a crash, and a recession. And that's just how cycles have happened in the past. And so all the bigwigs, Jamie Dimon, Warren Buffett, all these people sat back and said, hey, be careful, there's a crash. Now we've got Bezos and Zuckerberg and all the multi-billionaires, trillionaires almost, that are saying, hey, this is getting scary. And we're seeing them sell tons of stock because we're at that point where we've kind of peaked in just about everybody's mind historically, if you look at cycles and so forth. Now, a couple of things that are worrisome and why we're thinking this, we might be in that economic cycle, kind of the end of the gravy train, but maybe not. We've been there for a while now. This has been probably the longest prolonged bull market that shouldn't be, if you look at history, statistics, valuations, and other things, than we've ever had as far as the cycle goes. But we know the cycles eventually do catch up. And just because it's the longest doesn't mean it's not going to be a cycle. It just means it's the longest. It just means we haven't had one that's taken this long to shake out and do what it's supposed to do. So after the yield curve inverts, typically within about 6 months, we see a recession. We also see the Fed start lowering interest rates. And that's usually a sign that we're throwing in the towel. We know we're going into recession. We have to lower interest rates. And unfortunately, the Fed is typically late. Trump's been yelling about that. You're too late. You need to lower interest rates now. The inflation is really not a big deal. However, there's indication that inflation is still a big deal. And that's what's got Powell on the fence as far as how much he wants to lower interest rates, if it's wise, if it makes sense, and if he should do it quickly over time, or just make Trump and everybody in the White House happy that he's going to lower interest rates and stimulate the economy. Well, he can lower interest rates, but he only lowers the short-term interest rate. And that's really just the bank Fed funds rate that they get for overnight money that's parked between banks and borrowers and other banks and the Fed, right? So you don't have a handle on how long-term interest rates are going to be settled back in. We know that the long-term interest rates are finally a little bit higher than the short-term interest rate, just because the natural cycle has taken place where that's kind of come more into check. We are not seeing the price of bonds increase enough to lower the long-term interest rates on things like the 10-year bond or the 20-year bond. In fact, we've seen kind of a flat to down market, meaning that there's more sellers of bonds. And in other words, some of the foreigners like China and other countries and other central banks that own a ton of American debt, of the $30+ trillion in debt, is owned by people outside of the U.S. It's not owned by Americans. And so they're dumping it because the dollar's not as attractive looking based on the fact that we printed so much money. By doing so, they're kind of manipulating us into a higher interest rate environment, regardless of what the Fed does. And that's another reason that I think it'll probably end badly in a recession, and why I think people like Jamie Dimon, the big bank heads, the multi-billionaires of all the big Mag 7 companies that are pretty smart with money, or they wouldn't be close to trillionaires, right? They're all saying the same thing. Now, they've been talking about it's going to be in the next quarter to 2 quarters, next year to, and now they're saying, well, let's just walk it back. We keep on calling it maybe by next quarter, maybe by the first quarter of 2026, or a year ago, they were saying by the first quarter of 2025. Well, it didn't happen. What they do is they keep throwing money at it. They keep hyping the stocks. You get an election behind you. Trump says we're going to invest in this, that, and the other. And so everybody goes, nuclear and AI and crypto and everything that he says that he's going to support as a president, and the policies are going to support. And guess what? We get another run on the market, and we get another push, and we get another bull market in certain sectors. Problem is, it's not in all sectors. If you look at the market breadth, there's not that many stocks going up compared to the stocks that are going down. So that's another sign that we're probably heading for a recession, and we're kind of at the end of that cycle where that bull market and the growth cycle is down. Now, we're just now starting into earnings season. We have banks who used to make money on interest and so forth have been telling us that all their profits are coming from trading profits. Well, shoot, you can manipulate the market by trading, and just by the sheer volume of trades, banks have been able to make money through their brokerage houses. For example, Bank of America's Merrill Lynch, obviously. Chase's JP Morgan, Citibank, they've got their own. Bottom line is they've all got brokers. Wells Fargo is a broker. They're all market makers, and they all manipulate the market to their benefit whenever they need to. So banks are kind of like able to print money themselves. However, this last earnings season, we're starting to see that some banks are starting to make a little bit of money. Wells Fargo came out about a week ago and said, I think they were one of the first that reported this week, and said, we made money on increased interest. Well, I don't know if that's just because they're whacking people with 35% on credit cards now, and that's most of their debt, or if it's actually realized gains, or if it's just receivables because so many people are borrowing money. So it's really hard to say if they really made money on the actual collection of higher interest rates, or if the higher interest rates just made their books look better, and if they really called them realized gains or not. In fact, banks don't even have to call bad debt losses until they actually sell the debt. They can be unrealized. Most companies have to declare it. Banks don't. So, I don't know. If you look at what the banks are doing, they're still reporting that things are hunky-dory fine, but you did get Jamie Dimon saying, oh, we might have a crash. And in fact, a week ago, just before the Friday when it really got hammered, Jamie Dimon had just come out and said, hey, you know what, this is looking extremely weird how AI is way overhyped. There's no way that profits can be made to justify these prices. There's got to be a recession soon. And then he walked that back a few days later, earlier this past week, and says, well, maybe in the next couple of years. I don't think he said that in the original declaration of hey, we've got some problems that could be on the horizon. Well, that, and then Trump has this trade war with China. Actually, China started it. It's not, everybody's blaming Trump, but China said, hey, you guys need all this rare earth minerals and you guys are investing in your own production. And so until you get that, we're going to just like double, triple tariff you. And you have to tell us why you need our precious metals. And they're kind of holding their rare earth minerals hostage, so to speak, with huge tariffs. And Trump fired back and says, well, we'll double and triple yours too then. And there became a big scare that, oh my gosh, the world's going to shut down because China and Trump can't get along anymore. Well, they've never really gotten along, but they've never really hated each other and not been able to work things out either. I mean, every time there's a Trump tariff scare, it gets poo-pooed and it's gone in a week and the market's back to normal, just like it was on Monday last week. So it's hard to say how this cycle is going to play out. There's a lot of other factors that didn't exist before. I know that the most dangerous words in the world when it comes to investing or markets or anything that has to do with your financial livelihood is it's different this time. It always ends the same somehow, but sometimes the components and the ingredients to the recipe for the correction may be different, but the fact is it always ends up happening. I mean, now we've got this thing called crypto. We've got more money printed than we've ever had. We've got more people able to trade stocks from their basements on Robinhood accounts and on their phones. And we've got market makers being able to make the bid and the ask price. And I'm saying stuff that maybe not every listener understands, but there's just all this stuff going on behind the scenes that is kind of unprecedented, where the market makers can continue to manipulate the stock and kind of fake us out, especially when there's so many unsophisticated, unknowledgeable traders that just trade for the fact of a gambling habit on betting on the market and hearing whatever hype comes off of a CNBC show or some sort of a Kramer rant or something like that that says this is a stock you should buy, and then they go out and buy it and drive it up and the banks laugh all the way to the bank, so to speak, no pun intended. But there's a lot of things going on that concern me. While that being said, we do manage assets and we've been able to take advantage of this crazy bull market. We're outpacing all the market averages on our growth assets and things like that, where we don't recommend that you invest any money in the market you can't afford to lose. So not everybody wants to play in that. It's scary, very risky. If you can't afford to lose money, you don't want to take a big loss. The market can go up 20% in a year, it can go down 30. If it can go up 50% in a year, it can definitely go down more than that in a bad year. Bad years are usually worse than the best good years. So when you think of that and where we are in the cycle, we've been here for a few years now where we've been kind of top heavy, and it just could just take one little thing that gets out of line or one bad news report or a spark of what looks like a more serious war than we've already had, or more economic downturns, or some big company decides to sell off or go bankrupt, or find out there's misinformation on earnings and things and the economic backdrop isn't as strong as we think it is, and all of a sudden people want out. Like somebody cries fire in a theater and everybody wants to run out. People will get stampeded and people will get hurt, and people in the market who can't get out fast enough. And by the way, it's the big guys that get out fast, the rich guys, the market makers, the people that control the market. They get out fast enough. They leave the rest of us hanging, the little guys hanging. Now I'm in the market, but I'm not a market maker. I mean, I have to play the game and we have to follow the money. So we're kind of at a disadvantage from the standpoint of not being a market maker that has trillions of dollars of stock inventory on Wall Street. We have to play their game and watch what they do and be very careful. I think there's still opportunities to make money in the market if you invest smart, and we think we do that, but we also know that the risk is there and you better be careful or it could come back and bite you really hard.
Talk with Jeff Ogan of Premier Retirement Planning and Wealth Management right here in Tucson and Mesa. We're talking about current events, and if anything we talked about piques your interest, you'd like to come in, sit down, and talk with Jeff about your individual situation towards retirement and how the economic cycles could fit into those plans. 520-780-9059 is our telephone number. That is your opportunity to make an appointment to sit down with Jeff on a one-on-one basis. It's just a casual conversation to talk about how current events can affect your journey towards a confident retirement. Once again, that telephone number, 520-780-9059. You can make that call this weekend if you want. Leave your name, telephone number. Ashley will call you back during the week and set up an appointment for you to come in and sit down and talk with Jeff. Again, no cost, no obligation, 520-780-9059. Jeff, let's continue our conversation here about current events. JP Morgan just announced $1.5 trillion initiative to invest in strategic U.S. industries like defense and semiconductors and energy. Do you see this as a signal for long-term opportunity in American manufacturing? And how might individual investors participate in this without taking excessive risk?
Well, there's nothing about it that doesn't take excessive risk, in my opinion. These are rare earth mineral stocks that he's mostly talking about have been on a tear lately. There's some that are up 500 or 600%. we've been able to take advantage of some of them in our growth portfolios, but they're risky. I mean, shoot, they could sell off. You can go down 20% in a day and then go up 20% in a day. Yesterday, some went up 40%. It's crazy to see some of this, the money that's being thrown at these rare earth mining companies that do anything from antimony to lithium to other things. Now, problem is, for example, lithium takes great water sources to make it work. And there's all these things that might be barriers to actually have that growth. But we're looking at the United States, the Sovereign Wealth Fund or whatever it's called, that Trump's investing in these companies. JP Morgan and other big market makers are following suit, and they're saying, hey, we're going to throw money at it too, because if China's going to start putting huge tariffs on lithium and antimony and these rare earth type minerals, those are just two of many, but even gold and silver, I mean, they've been precious metals for a while, but they're not the rare earth type stuff. A lot more things go on with that. But we're looking at ETFs, exchange traded funds that have a variety of diversified portfolio of rare earth minerals going up 6 and 8% in a day. I've never seen an ETF go up 6 or 8% in a day. They have typically hundreds of stocks in them. And how does that work on a divided portfolio? I mean, a diversified portfolio, it works on one stock sometimes, but it's crazy how that segment of the market is getting a whole bunch of push. So there are some opportunities there, but also I play around and do day trading a little bit too. And I've hit some home runs with some of these, and I've also lost a boatload in some days. It's not for the faint of heart. It may be my little gambling side of me that wants to do that a little bit. But bottom line is there are some good solid plays in that field. But to my knowledge, there's really not a whole lot that don't have risk. Now, there is some of the things that we do because they are going to be a big part of indexes, including mostly the Russell 2000, because most of them are smaller companies, but there are some that are getting larger that might play into S&P one day or maybe affect the markets as a whole. Or if they generate enough money and people take profits, they're going to probably want to put them someplace else and maybe prop the rest of the stock market up. So I think from that standpoint, if you want to play it without risk, I don't know a simple way to answer that other than if you use indexed type products like fixed index annuities that have a floor that can't go down, but you want to take advantage of the market. Maybe we take advantage of the market that is more pro commodities or things that are not necessarily pure stock. You can also take advantage of the stock market because the stock market, if this is a sector that will drive the market and will carry the market, maybe the market has some upside, even if tech doesn't play out, or even if the consumer goods don't play out, or the discretionary doesn't play out, or energy, which is oil's going down in price, so energy companies might suffer. That might not be a good play, but maybe nuclear energy because of AI is, but not electrical or other energies. The thing is if you don't have a handle on the market and can't watch where the money goes in the segments, you're going to have a really hard time making it in this market because it's not broad-based growth. We saw that for several years, it was just the Mag 7 or the Fab 5 or whatever. The best 5 or 6 stocks were in the NASDAQ. The tech market was driving the entire market because they were both on the NASDAQ or the Qs. They were also on the S&P 500, and some of them also drove the Dow, which is probably more heavily involved in the financial world, which is somewhat manipulated and makes the Dow look propped up pretty easily. But you've got indexes are going to benefit by all these investments. Savvy investors, hedge funds, people who manage, their own funds like we do, will be able to take more advantage of those sectors when they become, I hate to use the word hot, I think it's a non-compliant word. It tries to instigate people doing irrational things sometimes, but there are certain segments that do get a little bit more attention and they do get a little bit more upward bias and they get pushed upwards. And right now, those segments that you just mentioned that Jamie Dimon and our own president of the United States said he's investing in as a sovereign wealth fund, our taxpayer money is going to invest in some of these and we're going to get a return that's going to help lower the deficits, pay off the debt, and do other great things. So I hope to heck these rare earth, which is kind of the main push lately, continue to go up. And, if your advisor isn't putting you in those things and you're just sitting there riding the market out, you're probably missing out. But again, you can't really do anything when it comes to chasing money that isn't at risk. But then again, when we know the money's flowing there, the risks, I believe, are not eliminated, but they're a lot less than just say, hey, I'm just going to throw money at tech stocks and see what they do, because only some tech stocks right now are carrying the weight of the entire technical market. And they typically have to do with AI, not some of the other areas. I mean, semiconductors, that's another one, obviously, to support the AI businesses are getting strong again, but it's typically the materials, semiconductors, and precious metals seems to be getting most of the push right now.
Talk with Jeff Logan of Premier Retirement Planning and Wealth Management about current events. Again, our phone number 520-780-9059. As you're listening to the program today, you can call that number and set up an opportunity for you to sit down with Jeff one-on-one, very casual basis, and ask your questions and get the answers that apply to you and your individual situation. Doesn't cost you anything, certainly, and there is no obligation. Jeff, I want to begin this conversation about the rule of 240 paychecks, paying yourself wisely in retirement. For those hearing that term for the first time, what exactly does that mean?
Well, it's kind of like one of those old rules of thumb or things that some people call out as some sort of an epiphany of wisdom or whatever. It really is simple. And by the way, 240 months, if that's a 20-year retirement, I guess if you're retiring at 75 and going to live to 95, that's okay. But if you're going to retire at 50, you might want to go maybe a 40-year retirement, maybe even go the rule of 480 paychecks, not 240. But keep that in mind. We usually do plans out to age 100. But there's a thing that we also talk about. I can't get credit for this one. It's been in the industry for a long time, but paychecks versus playchecks. You have paychecks are those funds that come to the bank every month that you know you can pay your bills on. You're going to need at least, if your 20-year retirement is going to need at least 240 of them. A 30-year retirement is at least 360 of them. 480 for a 40-year retirement if you're, let's say, 60 and you want to live to 100 and still have money. So what are those paychecks made of? Well, most people have Social Security. Hopefully that'll stay around for 40 years. Maybe it will in some form or another, maybe an adjusted form, maybe adjusted downward because they're not managing it very well and it's being depleted as time goes on. But what I think we have to realize is the peace of mind and the confidence in retirement comes from knowing all the bills are going to be paid, knowing that this lifestyle that you've chosen that helps you to retire on your terms is made up of those regular paychecks. The play checks are play money. And what I say about that is, if you're using money out of a brokerage account that can go up or down, up to 10 or 20% in a good year and down 50% in the worst of the years, or maybe even more if we have even a worse crash like back in the 29 era, or even the NASDAQ went down 83% in the dot-com bubble. If you've got a lot of tech-focused stocks, and even the S&P 500 now is more tech-focused than it used to be. So if we had a sell-off or a big AI crash like the dot-com bubble that burst, and we're in a bubble economy, that's what Wall Street does. Wall Street creates bubbles intentionally to pop them so they can sell high and buy low. I mean, I hate to say it, but that is kind of the rule of thumb. They can't do it every month or every week or every year. They've got to do it every decade or so. But so again, the risk markets would be the play checks. If you do really well in the market, and I've always said you should only put money in the market you can afford to lose, period. If you're getting paychecks and you want $10,000 a month forever with some sort of an increase for inflation, Social Security already provides for that. Some people don't plan for an increase in inflation. They just plan to spend more in the early years, and the inflation situation kind of works itself out as you get older and don't spend as much money. But bottom line is you need to set up a plan where you can count on these assets. Social Security is one, pensions are one. You can convert some of your retirement funds into annuities that guarantee lifetime income. Even if the market doesn't perform, and even if those annuities don't perform, insurance companies will insure that account to pay a paycheck for as long as you live, as long as you're breathing, as long as your spouse is breathing, however you want to set it up. In addition, you have the life insurance or the tax-free version of an annuity where you get lifetime income that can be tax-free, where you actually buy a big death benefit and you spend it all during your life rather than wait to die to make somebody else rich tax-free. You can actually spend it through borrowing against your death benefit while you live. It's kind of a cool concept. It's called the rich man's Roth. A lot of people use it. A lot of smart people use it. A lot of rich people use it. And guess what? It's not only for the rich. It's for middle-class, regular retirees like most of our listeners are that don't like paying too much in taxes, want some predictable income, even guaranteed income through annuities and other things that are guaranteed with Social Security, guaranteed with pensions, and then supplement with those things that can be counted on. But I wouldn't say even if the market's you're doing great and you're up 20, 30, or 40, or 50% in the stock market any given year, that could be all gone in a bad year. So you can't make your paychecks or those 240 paychecks or the 480 paychecks or the 360 paychecks, depending on its 20, 40, or 30 in that order retirement. You need to make adjustments based on your own situation, your own terms of your retirement, what your needs are, what your wants are, and what makes you feel comfortable.
Jeff, I want to continue this conversation about the concept of 240 paychecks versus 20 years in retirement later on in the program. But right now, I want to remind people you're listening to Jeff Hogan, Premier Retirement Planning and Wealth Management here in Tucson and Mesa. Our program is called Premier Retirement. And again, if you'd like to talk to Jeff on a one-on-one basis to ask any questions that you have about your journey towards confident retirement, you can do that by calling 520-780-9059. It's 520-780-9059. No cost, no obligation, certainly no judgment. We'll meet you where you are. 520-780-9059 or online at primret.com. Jeff, time for break, and we come back here on Premier Retirement. We've got listener questions and more when our program continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shea.
Thanks so much for making this part of your weekend. You're listening to Premier Retirement right here on 790 KNST, Tucson's most stimulating talk. I'm Jeff Shade, joined by Jeff Vogan of Premier Retirement Planning and Wealth Management. And remember, you can hear us 4 times a week. If you've missed any part of this program today, we're on the air on Saturdays at 7 a.m., 9 a.m., and also 1 p.m. We're also on the broadcast here Sundays at 11 a.m. If you've missed any of those times, you can hear us on your schedule, on our podcast. Go to wherever you get your podcast, search for Premier Retirement with Jeff Vogan. You'll find this show and all of our past shows so you can stay on top of your journey towards a confident retirement. Our phone number today, 520-780-9059. If you hear anything in the show that piques your interest, you'd like to talk to Jeff on a one-on-one basis about your journey towards a confident retirement. Maybe you've got a retirement plan. You want a second look at that. Maybe you don't have a plan. You want a first plan. Give us a call here at 520-780-9059. Schedule an appointment with Jeff and begin that conversation. Okay, Jeff, time for listener questions. Let's jump in right now with Ron listening to us in Tucson. And Ron says, I'm 50 and my new employer offers a 401k plan that I'm about to take advantage of. There are a lot of choices as to where I want to invest my money within the 401k. How do I go about choosing the right ones?
See, that's the thing about 401ks that's frustrating, is because they typically don't come with an advisor that helps you. We do that with a lot of our clients that are already clients, and obviously if they're having a 401k, they can, come to us. There are some platforms that allow people like us to manage the 401k or have some input on a fee base so that we're getting paid for our time and effort as well. But if you're 50, you're getting towards that time when it can't just be all put in super aggressive and just hold and hope and see what happens. Although if you're just barely starting out, it wouldn't matter if you went aggressive to get started and just dollar cost average in. If the market's up, the market's down. It's not a life-changing event. It's not like you're starting with $1 million in a 401k. Now, I would just suggest as you start that 401k that you take advantage of every dollar that the company will match. If they'll match you up to 5% of your salary as far as savings, make sure you put that 5% in, because you're doubling your money because you're using their money on top of it. That gives you a lot more buffer that if the market does correct and go up and down and get a little bit volatile, that you're not really losing any of your own money. You're just kind of having to wait for the rebound on company money, so to speak. So I would say, if you've got a 10 and 15 year time horizon, you probably better just dollar cost averaging if you're just starting out. I wouldn't keep it that strategy. When you get a year or two from retirement, you might want to start dialing back as you get closer. Maybe every 5 years you get closer to retirement, you start dialing back on the risk element. 401ks have come out with these things like retirement 2030 plans. Are basically based on when you retire, how much stocks and bonds they have. They're very static and they're very unmanaged, and they're very, honestly, I think they perform very poorly. For example, right now, I wouldn't have any money in bonds longer than 2 years until long-term interest rates start going down. Right now, the short-term interest rates are going down. That doesn't really make a short-term interest rate bond increase in value. But if long-term interest rates start going down, bonds will start growing in value again. But they haven't for a while. There's been a lot of pressure in the bond market. Bonds are flat to down over the last year or two. If you look at the last 3 years, they're way down. And if you've had this retire 2030 or retire 2040 or some sort of they call these things target date retirement plans, where you kind of target your date and then they just manipulate it into, don't even manage it. They just throw it at some bonds and some stocks thinking that that's supposed to get you there. Well, if bonds are going down over the last 3 years and you've had a 50-50, let's say you were going to plan on retiring in the next 3 years or 5 years, let's say, and 5 years ago you put money in bonds, 50-50 in bonds and stock, those bonds are still down probably 20 or 30% from when you got them. 10 at least if you had an aggregate bond portfolio. The stock market probably went down. You may have 50% of your money, may have, got back some of it. Maybe you're up 20% in 5 years. Well, that doesn't really make a lot of money because the bond market has killed most of the gains in the stock market because you've had to have both. It's really too bad that 401ks don't allow you a little bit more access to understanding the market trends, what's smart to invest in, economic cycles, whether interest rates are on an upward trend or downward trend, how bonds work in a upward trending or downward trending interest rate environment, how stocks work, whether you can invest in different sectors of the stock market, or if you only get access to the indexes is another thing. So some 401ks are kind of anemic. I think 401ks, because they're not really traded, are kind of the foundation for which big market makers and the big money and the banks kind of can rest their laurels on, knowing that, nobody's really going to start trading or selling or moving money around in 401ks. And as long as they can have you stuff tons of money, you take all the risk, they can trade on the side, knowing that that's their security blanket of funds that aren't going to be traded in the market or run for the door or have people going crazy during market corrections. So you're kind of a pawn in the big game by doing a 401k. However, having said that, I still think you should invest in a 401k. In my opinion, if you still got 10 or 15 years, pick an aggressive fund. Don't do target date funds because they keep you in certain sectors that may or may not be good at any given time. I would pick the sectors that have good history and track records. And if you need help, then hire an advisor. And some advisors will just do a fee-based planning session with you every year. I mean, we have that option open, and you could get a little bit of feedback. If the company that uses the 401k doesn't have advisors that can help you, and by the way, those advisors sometimes are only advisors that know how to do paperwork and don't really know market trends, and they'll just throw you into those target date funds and things that are very inefficient. But finding a good advisor to help with 401ks is kind of few and far between. Again, there are platforms that will allow companies like us, depending on your 401k, to actually manage it for you for a fee. But if you can beat the market by 5 or 10% because you're not losing money on bonds when you shouldn't be in them, paying an extra 1% fee to somebody to help you might be very much worth it.
Ron, we appreciate you listening to us in Tucson. And again, if you have questions, call Jeff at 520-780-9059. We'd love to talk to you. Kevin is listening to us in Green Valley, Jeff, and Kevin says, I have 2 daughters, aged 21 and 23. Their mom, my ex-wife, died in March of 2024. My daughters inherited 401k money as their mom was currently employed, and they also inherited some IRA money. I want to know if I can turn inherited 401k funds into a Roth. I'm unsure of the process and can't really find any information pertaining to the topic. Might you be able to help me?
Well, as far as your situation goes, if you're a non-spouse inherited IRA recipient, so you're not a spouse, you can't do a Roth conversion. You still have to take those funds out within the next 10 years. You can invest them however you want to. You could, however, take some withdrawals out, pay taxes on it, and then convert them to your own Roth if you're able to contribute to a Roth. But if you're a spouse, you can roll it over, use it as your own. There is no 10% payout rule, and you can convert that to a Roth in increments, or you can do that in lump sum, depending on what your tax situation is and what your tax planner would tell you to do. So, we would always look at the math and see if it makes sense to do a Roth conversion if you're going to go into a higher tax bracket. And sometimes when you're a single, like a spouse, and all of a sudden you go into a single tax bracket, find out you're in a higher tax bracket than you would have been, it might make sense to do a conversion right after death, even in the year that the spouse died. So you're in a lower tax bracket on more money, and you can take advantage of that lower tax bracket, move that money while you have 2 people on that tax return, and file as a joint married couple rather than a single the following year. So that's one of those things you probably want to get on right away if you can. And if not, then you have to probably do it incrementally, keeping very much in mind your tax bracket going forward. But as far as being a non-spouse, if you're a child, daughter, son, a cousin, grandkid, whatever, if you inherit that IRA, they're not Roth convertible.
Kevin, thanks for that question. And of course, thanks for listening to us in Green Valley. We'll send you out Jeff's book, Retirement: The Road Ahead. And we invite you to call Jeff here at 520-780-9059. We can sit down with you on an individual one-on-one basis and explore this a little bit further. Jeff, next question is Steve, listening to us in Marana. Steve says, what is risk tolerance versus risk capacity, and how does it impact my investment decisions?
Oh my gosh, that is such an awesome question. I really like that. I try to talk to that about clients. I have clients that are very wealthy and could afford, they have capacity to risk more than half of their assets, probably all of their assets, because they have huge pension money, maybe a trust fund paying them $150,000 a year that pays all their bills. They don't really spend a lot of their money. They could risk it all and probably just sit on it forever, make a ton of money, and be fine. Even weather the storms of big market corrections, because eventually they all come back. It might take 10 or 20 years, but they all eventually come back. However, they might not have any risk tolerance. I have clients that are very well off, that have millions of dollars in savings and don't want to risk a penny. They go, why do I want to risk or even feel the gut ache of losing $100 in my portfolio if I can help it and not have it go down? Well, that's perfect opportunity for people that use principal protected accounts. I'm not talking just CDs and savings accounts. I'm talking about the indexed products that could be tax deferred on non-IRA money. They could grow if the market goes up, and they don't go down if the market goes backwards. There's plenty of places to still get good returns if you have no risk tolerance, but have risk capacity. And if you have risk capacity, then you have the capacity to sock away money and put them in 5 and 10 year contracts that you don't have to touch, but can grow and you don't have to worry about losing money on. Leaving it for your heirs, building a legacy plan or whatever. But risk tolerance, I have a lot of people that are, for whatever reason, very risk tolerant, but in my opinion, don't have the capacity to risk. And I caution them against it. And sometimes they're not a fit for our business, because if you've worked a lifetime to acquire what you've got, and just because you haven't seen a market crash in the last few years and you think the market's going to the moon forever, The fact is it may not. And I could be wrong. Maybe it's different this time. But those are dangerous words, and those usually don't play out. Usually cycles complete, and we're in a cycle, and it's getting at the peak of the cycle, and I don't know when it's going to correct, but it eventually will. Maybe it's this year, maybe it's 10 years from now. I don't know, but it will. If you don't have the capacity to lose half of your assets and still make ends meet, then I would not recommend you go into it regardless of your risk tolerance, because you would not have risk capacity, in my opinion. Again, we want to make sure that your livelihood is met with those paychecks. Remember, like we talked about in our last segment, the 240 paychecks or the 360 or the 480, however many paychecks you need to make it from the time you retire to the time you breathe or your spouse breathes their last breath. You want to make sure that those paychecks keep coming. If you can set that up first, then I think, if you're risk tolerant, then you have the risk capacity on whatever's not needed for that monthly paycheck type stuff. That's why we call it play checks. The play check would indicate your capacity. How much do you have in play check money, the capacity to risk? And how much of that do you want to risk? Is your risk tolerance high? Great. Then risk all of your capacity to risk. If you have immediate risk tolerance, don't risk half of your assets, risk half of your capacity or half of the assets that you can afford to lose. That would be how I would address risk tolerance versus capacity. That's an excellent question. First time I can remember having that one, but we talk about that in our planning process. I don't necessarily use those two words as we talk about it, but it's definitely part of the plan. Is how much can you afford to lose is how we talk about capacity. How much gut ache are you going to feel on a scale of 1 to 10 if you lost half of your investments in the next market crash if it happened? That would give you an indication of your risk tolerance number. So keeping those both in mind will help you develop a plan that will help you feel confident going forward in your retirement.
As Jeff said, Steve, very good question. We appreciate you listening to us in Marana. And of course, you can call us here at 520-780-9059 if you would like to have a further discussion on risk tolerance versus risk capacity. Again, you're listening to Jeff Bogan. This is Premier Retirement right here on 790 KNST. Phone lines right now are open 520-780-9059 if you would like to set up an appointment to sit down and talk with Jeff about your individual journey towards a confident retirement. We invite you to call that number and set up that conversation at no cost. No obligation whatsoever. 520-780-9059. Leave your name, telephone number. Shelley will be back with you during the week. We'll find a time that you can talk to Jeff and set up that conversation for you on your schedule. 520-780-9059. Of course, we're also online at primret.com. Jeff, let's continue this conversation here about the psychology of 240 paychecks versus planning a 20-year retirement, or as you said, a 30-year, 360 paychecks, whatever it happens to be. Sort of like eating an elephant. You don't do it all at once. You just take it one piece at a time. So let's get practical, Jeff. How does someone actually turn their savings into a steady paycheck? 240 paychecks. Where should those 240 paychecks come from?
Well, some of them are going to come from Social Security, I would imagine. Pension would be some others. And annuities really are the only other answer, in my opinion, if you want guaranteed income, because they're the only place that actually guarantees payments regardless of whether or not you have money in that account. Payments will outlive the account value in an annuity, in a fixed annuity that guarantees income, even in some variable annuities, although I don't like variable annuities because of the fees and the lack of performance historically. But I really like the index annuities that guarantee big income bonuses up front. If you don't just park it there for a few years and take the money back, the company will give you extra credit for taking it out over the next 240 paychecks rather than just taking a lump sum out someday, because lump sums hurt the company for their business plan as well. They like cash flowing in and out. Their business plan is better and they're able to pay you more if you do that. Some companies, even while you defer income, will grow your assets. One of my favorite ones, I'm not going to say company or name, but it grows the assets by 9% or more per year that you wait to take income. So in other words, if you bought an annuity that would give you, let's say $10,000 a month in income, every year you'd get a 9% growth on that. So if you waited just 8 years, you'd actually have double the income, and it would actually be tuned up, ratcheted up even higher because your age would get older. So what if you waited just a few years, maybe get 30 or 40% more income? Again, you like to use these annuities and plan in advance of retirement if you can, because you get that guaranteed growth regardless of what happens in the stock market in the next few years. You don't have to say, well, I've got 3 years before retirement. Let's see how my 401k does. And whatever it's worth in 3 years from now, which could be more or less, I'll convert to an annuity. Well, you could convert to an annuity, lock in what you have today while the market's high, guarantee growth on that amount no matter what happens. So even if the market crashes, your income is guaranteed and is guaranteed to grow. I like annuities for income, for filling in the gap between what you have and what you need, and then adding a little bit for what you want. And Also considering the taxable events of that income stream. Is it coming out of an IRA? Is it going to be taxable? Is it coming out of a Roth IRA? Is it going to be non-taxable? Maybe you have a bunch of money that is not in an IRA that's outside of an IRA. Maybe you have $1 million sitting in mutual funds and different things that, when a good year happens, you could pay tax on $200,000 extra in mutual fund trading profits that you didn't even count on because you had a good year. Well, what about putting that money, converting it into something like a LIRP, a life insurance shell, which grows tax-free, that you can borrow multi-millions of that million tax-free over the next 25 or 30 years in retirement, and it's all tax-free. Never had a tax bill, never pushes you into a new tax bracket, never increases your premiums on your Medicare and things like that. Some people don't realize that the more you make in retirement, the more everything costs you, including the taxes you pay on your Social Security, your tax brackets, obviously, and even the amount you pay for your Medicare insurance premium. So all those things considered, you want to be in the lowest tax bracket, or at least look like you have the least amount of income possible while you live on the most income possible. And you can also do that by combining annuities, LIRPs. I like them, especially because the cash flow is tax-free. And if you use the tax equivalent yield from an annuity and a LIRP, generally speaking, your net yield is going to be a little higher on a LIRP. And you have a nice little death benefit built in so that if you should die, your spouse or your loved ones get the benefit of the extra tax-free money that's in that account. And if you'd prefer, you could use that extra money, the death benefit, for long-term care in your final days or a terminal illness to take care of final expenses and make you have a comfortable exit plan, so to speak. So there's a lot of different ways to create income. The other thing you can do is, if you want to invest in some stocks and say, hey, if the market goes up, I'll just take the profits on those years and we'll do something fun. If it goes down, we'll wait till it comes back, and that's just my play money, and we're only going to use it when it makes money. Or if you can live on a small portion of it, then maybe the 4% rule comes into play, where you've got $500,000 and you want to use $20,000 a year. Well, that's probably a pretty safe amount to not run out of money in that account if you just wanted some paycheck money. So you can build a plan with different tools, different income funnels, different income streams, different investments. And that's why our 5-step plan is create the plan, make sure your investments support that plan, make sure that they create income, and how many sources can create that income, make sure it's tax efficient, make sure there's enough for those long-term health bills or those surprise health issues that happen. Taxes and healthcare are the two biggest expenses in retirement. So you have to prepare for those as you do an income plan. And then what's the legacy going to be? What do you have left over if you don't spend every last dime? Now, some people's legacy plan is spend every last dime and set your kids up while you're alive, or maybe you already did, or maybe they're already set up better than you. Maybe they're not. But bottom line is, those are the 5 steps. None of them can be left out of the planning process, or in my opinion, wouldn't be a comprehensive plan. It wouldn't be a smart plan. We like smart planning, and we like taking advantage of all those different things and taking each of those aspects into account and using every tool that we can for income as it applies to your situation.
Jeff, a lot of people have heard of the 4% rule for withdrawals. How reliable is that today? And when might someone need to adjust it?
Well, actually, Charles Schwab just did a report, and they'd already adjusted it down to 3.4 or something like that. Now, before that, during COVID, when we had that little hiccup, and we also had the lost decade, there's a guy named Wade Pfau who's actually created a degree in college for retirement income planning and added to a kind of the financial focused college degrees. And it's important as more and more people, baby boomers, retiring, to make sure that their income lasts. And the old 4% rule is built on a chassis that said you're going to retire for 25 years. The bond market is averaged about 6%. Stock market averages 10, but because of volatility, well, we can take out about 4%. That was William Bengen. I think the year was 1993 where that came to be some sort of a rule of thumb. And it's been pretty much held true until the end of the decade of 2000 to 2010, where there's 2 market crashes and people said, wow, what happens if you retire right at the end of 1999 and go right into the first crash, and before the market gets back to even, you're living on 4%, and all of a sudden the market gets back to even and crashes again? Is the 4% rule going to hold out if you have your money in stocks and bonds? And the answer is it won't last. In fact, I think there's been numbers down around the 2% range if you happen to retire on an unfortunate date at the market's high, like right now, right before the next crash, like could happen anytime. You may end up leaving all your money at risk and end up spending all your money, or a big enough portion of it, while it's down, that your income will not be sustainable. So the 2% rule might be kind of a more realistic approach. Schwab, even one of the market makers, that it's not in their best interest to say the 4% rule doesn't work. In fact, it would be in their best interest to say, hey, we think you can take 5 out because we're great investment managers and the market always comes back and it always does great, and don't worry about things, you'll be fine. But the fact is they won't be fine. Actuarially speaking and mathematically speaking, it won't play out that way. So If you use other tools that I just talked about in that last question, is we've got annuities that, let's just say you have $1 million and let's say you want to take the 4% rule out and you're pushing your limits and you think you'll be okay. That's $40,000 a year off of $1 million. Let's say you put $600,000 and let's say you're 70 years old and you put $500,000 in an annuity that gives you guaranteed income and you put the rest of it in the stock market. That $500,000 in an index annuity would pay you out the same amount as a 4% rule would on $1 million. What that gives you is the $500,000 that's left can be managed and be left alone. You still get your $40,000 guaranteed, even on the $500,000, depending on your age and the product that you use, guaranteed for life. Might be a little bit less if you have a younger spouse that you want to put on there as a survivor as well. But bottom line is it's better than the 4% rule because you don't have to use all $1 million. In fact, if you use $1 million, you could probably get up to an 8 or a 9% rule and have income off of that if you use the whole thing for income. Most people don't like using the whole thing for income. They've already kind of grown accustomed to the idea that they're going to have a 4% rule come to play. So when we do a plan and find out when they think, well, with the 4% rule, my total income should be around $100,000. And we show them that, no, your total income should be around $120,000 and you still have $400,000 left that you don't even have to touch, that you can be aggressive with, which increases your risk capacity, as we talked about earlier. And if your risk tolerance is such, we can invest 0 to all of it in things that have a chance to make double-digit returns on a consistent basis. And if they're managed well, they don't go down when the market goes down, at least not to the extent that it goes down. We hedge and we put stop losses in and we don't ride the market all the way down to the bottom just because we think it'll come back. I know they say you can't time the stock market, but you know what? There's times in the stock market that just don't make sense to be in it. And when the market's selling off, it doesn't make sense to be in it. The trend is your friend, and if the trend is down, we stay out. If the trend is up, we stay in, regardless if it makes sense. Right now, the trend is up, and it doesn't make sense, but we're in it because the trend says so. So again, it's still risky. Can you still lose money? Yeah. If you don't have a strong stomach and you're faint of heart, you shouldn't be in it. But if you have risk capacity and risk tolerance, then you should be all over it right now because there's opportunities.
Talk with Jeff Hogan of Premier Retirement Planning and Wealth Management about the concept of 240 paychecks versus a 20-year retirement lump sum. Again, it's an interesting concept. If you'd like to explore that more with Jeff, call us at 520-780-9059 and set up that conversation. There's no cost. There is no obligation for this whatsoever. Jeff can talk about any number of things as it relates to your retirement planning. Not a limited scope advisor, but a full scope advisor here with a lot of tools in the toolbox. So once again, take advantage of this opportunity. It's not going to cost you a dime, and there is no obligation. 520-780-9059. You can also find out more about us online at premret.com. Well, Jeff, we just get started, then we run out of time. I want to thank you for your time, but most importantly, I want to thank our great listeners for joining us here in the greater Tucson area. So for Jeff Hogan, I'm Jeff Shade. Have a great weekend. We'll talk to you again next week right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.